welcome to this TIOmarkets webinar on gold and oil. In addition to the multitude of currencies which we offer for your trading pleasure, we also offer various commodities, of which gold and oil are probably the two favorite for traders. Both can be quite volatile, so you need to keep in mind your risk appetite when trading, and we always recommend placing stop losses on any open positions. So what make gold and oil move? Different factors, although some are actually very similar between the two. Looking at gold, first of all, I'm sure many of you have heard gold referred to as a safe haven, a store of value. And gold is often something which will appreciate in value when global economy is not necessarily doing particularly well. Something like we saw back in 2008, the financial crisis there. People also tend to buy gold when there's not just economic uncertainty, but political uncertainty, social uncertainty. It's a store of value, and can certainly be a very attractive investment when things are uncertain in the world. Conversely to that, when things are going really well, when economies are doing well, when stock markets are rallying around the world, gold tends to suffer as a consequence. Gold is also referred to as a hedge against inflation. Part of this is due to its relationship in terms of real interest rates. Now, real interest rate is the nominal interest rate in whichever country you're referring to, less the inflation rate. So if you had 3% nominal interest rate and you had 2% inflation, the real interest rate would be 1%. And in times of very low interest rates or real interest rates, when you're holding cash in savings accounts, government bonds, things like that, which are all interest yielding, but they're going to yield very low rates of interest. So traders tend to like to buy gold during those periods of time. The flip side of that is when the real interest rates are much higher, traders tend to sell gold because obviously they can get a much higher yield off a bank account or off a bond that might be offering 4 or 5% in terms of a real interest rate, as opposed to a lump of yellow metal that's really only used in the real world for making jewelry. And at times like that, you'll see gold get sold. So those are the a couple of main factors that make gold move around. But it's certainly volatile, and if volatile markets are your thing, then it's a great asset to trade. Moving forward to oil, also a volatile commodity. Factors that will directly affect supply and demand of oil is what moves the price around. And I think probably the most extreme example I can give of that is if you look at a chart, maybe going back to 2008, or if you were around in the markets back then as I was, in June of 2008, the price of oil rallied up as high as $145 a barrel. Most of that was down to two reasons. One, on the supply side, there was some political uncertainty in Nigeria, one of the major OPEC producers. At the same time, there was a view that there was going to be a lot of increased demand from emerging economies such as China and India. So you had demand rising, supply potentially diminishing, and all of a sudden we have a very sharp rise in the price of oil. Of course, just as that happened, the financial crisis started to take effect, and between June and December of 2018, the price of oil collapsed from $145 a barrel down to $30 a barrel. Much of that came from the fact that there was a drastic economic decline globally. Demand for oil, therefore, whether from emerging economies or some of the stronger economies around the world, would decline, and therefore demand was going to be less, and the price dropped accordingly, even though the political tensions in Nigeria continued. So that's a great example of how the oil price can move, obviously at an extreme, due to factors affecting supply and demand. Other factors that can affect supply and demand, obviously, a lot of oil is produced in the Middle East. There's constant threats of war and social disruption in the Middle East. That can certainly have effect on the price of oil. There's a lot of rhetoric between countries like the United States and Iran, with Iran constantly being put under US economic embargoes, and just recently they've essentially banned any country from importing any Iranian oil. Potentially could put the price of oil up as one source of supply is diminished. So things like that can have an effect. And then the final one, which tends to be a little bit more short term, can actually be weather. There's a lot of oil is drilled for in the Gulf of Mexico, and during hurricane season, we can quite often see a disruption to supply from the Gulf of Mexico. So different factors. Some factors are the same, but oil and gold are certainly two commodities which are very widely traded around the world, not just by retail traders, but also by professional traders, financial institutions, and hedge funds as well, and also very popular to trade due to the volatility associated with them. So we wish you the very best of luck trading with them, and as I said before, just be mindful of your risk appetite, and always put a stop loss on your open positions.